One of the toughest things about day trading or shorter term investing is controlling your human behavior. I've been a professional investor since 1990, and even I can be heavily influenced by what the market's doing. But if the market is dictating, that is the volatility of the market is dictating your investment decisions, then you're no longer in control and you're really not a disciplined investor anymore. The market is an auction. In the short run, it's a voting machine, very emotional. In the long run, it's a weighing machine, it weighs value.
Don't forget to sign up for our free portfolio review with one of our partners at Wealthion.com/free. With markets at all-time highs after a crazy year, now's a great time to review your portfolio and get prepared for what's to come. Jonathan, thank you very much for joining us today. You and your team at RockLinc Investment Partners are based in Burlington, Ontario, and your investment philosophy is one of value investing, and this is totally different from another type of investing, and that is more speculative in nature, or what we might call short-term trading. And I thought it would be a good idea for you and I to spend a few minutes discussing the differences between value investing and speculative investing. So why don't we just start right there with the value investing? What exactly is it?
Sure, great question. I think it's important for the retail investors really to have an investment philosophy, and they might choose one or the other, but it's consistency that is going to be very important for them. So when we look at value investing, what we're talking about is we're looking at the fundamentals of the businesses primarily. We do look at the economy and have to contextualize the business always, but basically you're looking at the company. So you're getting into the business, you're looking at the fundamentals of the company, you're looking at its competitive advantage, its ability to grow, its earnings, the growth in the industry. You look at different financial measures, the balance sheet, income statement. Is this a strong company? Is it a company that's got a future? You look at the management team, corporate governance. So you really get into the business as if you were going to buy the whole thing. I mean, you're really thinking like a business person. Is this a company I want to own for the next 3, 5, 10, even 20 years? Yeah, I want to hold for the long term. And then you put a valuation on it. So you're going to spend quite a bit of time saying, okay, what is this business worth if I were going to buy 100% of it? And of course, you divide by the shares outstanding and you figure out what, per share you should be paying. So you start to look at valuation metrics, price earnings ratios, price to net asset value. So the assets that are on the balance sheet. You're going to look at things like that, cash flow. A lot of things that we look for in many of our businesses would be a cash flow, free cash flow. And then you do a business valuation. And then you say, okay, here's a stock that maybe is trading at $100 and we think it's actually worth $125. And so we would look at that and we say, okay, there's a 25% discount to what we think it's worth. And then we'll look at it and say, is that worth going into and buying and taking a position with the idea that over time it's going to grow and continue to compound, and that $100 valuation, which we think is worth more, it's going to continue to grow and things like that. So that's really value investing, thinking like a business person, looking at all the fundamentals of the business, putting a valuation on it, and trying to buy it at a discount to where it's trading in the marketplace, so that you have what we call a margin of safety, and then staying with that stock over an extended period of time. That's really, I think, some of the key elements of value investing.
And when you say staying with the stock over an extended period of time, can you define that? How long of a time period?
Well, Warren Buffett says his favorite holding period is forever. And so this is, I think, a very important issue. If a company continues to grow and continues to compound, there's no reason to sell it unless a couple of things arise. Number one, it becomes maybe grossly overvalued, so that you could run the risk of the stock coming back quite a bit, and maybe you just made 5-10 years of return very quickly. And we've seen that in some stocks. They'll run up to ridiculous levels, and taking some profits can be wise, even though it might be a great long-term business. The second issue is you run into trouble in the business. The fundamentals start to change. One of the things that you're doing when you're value investing is you're following the company. You're on all the earnings reports, so quarterly earnings reports. You're usually talking to management from time to time. And if things get off track, and you're concerned about the growth going forward, then of course you would sell. And the other reason that we might sell and interrupt the long-term holding period is that we just have a better opportunity arises, and we don't want to be continually adding stocks to our portfolio. So we like to keep our portfolios at 20 to 25 stocks. So if we're at 25 stocks, we don't want to go to 26. We don't want to go to 27, 28. So you don't want to continue just adding more stocks to your portfolio. So we'll trim off the companies that we think are the least have the least opportunity going forward and growing. But otherwise, we stay with companies for long periods of time. And we can talk about this later, but you have a huge tax advantage when you can compound in a business for an extended period.
Before we discuss the benefits of investing or value investing, why don't we first talk about speculative investing or what some might call day trading? Maybe you can just touch on that and how that approach is different from value investing.
Yeah, there's, of course, many different ways that people will day trade, but I would suggest that the shorter your time horizon, especially a 24-hour day or a market within 6-7 hours, the shorter your time horizon, the more you're really speculating, because there's so many things that are out of your control at that point. So that's someone who's focusing more on short-term price movements. Maybe news in the market that they think is going to move the stock inordinately in one day and create some volatility. It could be more momentum investing. So there seems to be momentum in a certain area. Then they want to jump into a stock and take a short-term trade and sort of ride the momentum. Some can use technical analysis. Now, technical analysis can be used for value investors also if they're looking at different trading patterns and so on. But a lot of technical analysis can be quite short term in its orientation, and therefore they'll make trades very quickly. They'll buy and sell and try to run the momentum, see if the news has a big impact and so forth. So they'll have high turnover, and typically, again, you're going to get turnover for a value investor might be 5 years. You might have one turnover in 5 years on a stock. On a speculative investment, you could have it, trading a couple times a day or certainly a couple times a week and so forth. So yeah, they're really looking more at short-term volatility in the marketplace and then playing that volatility and trying to work that to your advantage.
Throughout the month of September, we're shining the spotlight on gold with a lineup of expert conversations, sharp market analysis, and practical investment advice. Be sure to grab our free gold investing report using the link in the description below. And if you're looking for a simple, secure way to invest in physical gold and silver, check out Hard Assets Alliance at hardassетsalliance.com. Speaking of silver, Wealthion will be in Toronto in October for the SCP Resource Finance Global Silver Conference, where Eric Sprott will deliver the keynote address. If you have an interest in silver, you want to be there. If you want to attend in person, sign up for our accredited investors list by going to wealthion.com/accredited. For virtual conference tickets, follow the link in the description below. Now, let's get back to the show. Something you said that really resonates with me. I know when, of course, there's been times over the years when I focus on short-term trading or short-term strategies, but you get caught up in all the noise in the markets. And this year has been, a perfect example of that, right? There's been so much going on just from a political point of view, an economic point of view, and global trade, et cetera. And because of this, there's been a lot of volatility in the marketplace. And so you get these massive drawdowns in the market or big pullbacks, and you might think, oh my God, okay, I got to go all cash. And then next thing you know, the market stabilizes and it takes off again. And we've had that this year. And now the S&P is trading at all-time highs. So maybe you can just speak to that and how the value investing basically does away with all the short-term noise.
Yeah, I think value investing and how lower turnover investing, taking longer term periods of time when you're in the stock, really reduces your risk, because now you're looking at the longer term fundamentals. You're looking at the executives that are running the company, the industry, the brand of the business, its moat, its franchise value. And so yeah, the stock price might bounce around, but those things, a really well run company, the true value of the company does not move around the way the stock market does. And so that's why Buffett has this expression, is, time is your friend when you're in a good business, because you can be in the stock market and all of a sudden it gets manic. As we know, it gets manic and depressive. It gets depressive, it sells off on news. That news really doesn't materialize, and you panic, you sell out. But if you have a great business, you go, you know what? This short-term news is not going to affect the long-term franchise value of Berkshire Hathaway or Apple stock, or you can name all sorts of businesses. And so therefore, I'm going to actually take advantage of the downstroke and actually buy more if I've got cash coming in. And so it gives you a much stronger foundation upon which to build and have confidence, so that you're not spooked. Because one of the toughest things about day trading or shorter term investing is controlling your human behavior. It's a psychology which can just take over, and that fear of missing out. There's all sorts of terms that people use. But again, I've been a professional investor since 1990, and even I can be heavily influenced by what the market's doing. But if the market is dictating, that is, the volatility of the market is dictating your investment decisions, then you're no longer in control, and you're really not a disciplined investor anymore. So we can't let the market dictate our investment decisions. But that's what happens in a shorter term time horizon, and you can easily get spooked, leave a lot of money on the table. Yeah, there's a stat that's really interesting. You go back to Peter Lynch. Peter Lynch was an amazing investor at Fidelity, and from 1977 to 1990, he ran the Magellan Fund, and he really popularized mutual fund investing. I mean, he really was a tremendous leader, and so his average return from 77 to 1990 was 29.2%, according to Fidelity. And yet, if they did an analysis on the average return of investors in the fund, and it was basically under 7%. And so what you had, again, is people buying it when it was moving up and then selling when it was going down, and so forth. And so it's very hard to control your emotions. And if you're a shorter term investor and you're basing your investments on fundamentals, which are rock solid, then I think you can get spooked at the wrong time. Buy when everyone else wants to buy, and sell when everyone else is panicking.
And I think you touched on a very valid point, because a big part of investing or trading, whatever you want to call it, it's this psychological component. And I often think this is one of the reasons why Warren Buffett has been so successful, is he's unemotional about what's happening in the markets and throughout the world on a day-to-day basis. He's thinking 5, 10, 20 years out. And he doesn't get caught up in all the noise. And when he does see a big pullback, like we saw earlier this year, or that we've seen here in the last 5 years, he takes advantage of that pullback. He doesn't see it as, oh my God, I got to sell and raise cash. I'm going to go in and buy more of these stocks or companies that I really like.
Yeah, and in fact, as we've seen recently, and also really 2007, 2008, he made sure he had quite a bit of liquidity when he thought the market was expensive. And so when things did drop, as we saw with the great financial crisis, he was able to step in and support all sorts of businesses, and he got sweetheart deals. I mean, you know what he did with GE. He got it with Goldman Sachs. He got it with some of the banks where they gave him these preferreds, where he's making a boatload of interest, but they're all convertible into stock at very low prices. And so he just can wait for these opportunistic times, because he is a disciplined investor. I mean, part of being a value investor should be tremendous discipline and patience. And as you know, you can make a lot of money in short periods of time when everybody else is panicking. But that requires a psychological strength. It requires really knowledge of where you're investing, so that you have the confidence to step in when other people are hitting the panic button. And that's not an easy thing to do. I can tell you, having been in this business for 36 years, when you're going against the market, you feel it. You feel it in your stomach. And of course, you're managing other people's money, so you're trying to be a tremendous fiduciary. And people are putting pressure on you often. And so you have to, again, get back to the fundamentals and your knowledge. If you're taking a value investor, know what you're buying, know why you're buying it, and that'll keep you in the stock, I think, for longer periods of time to get the benefit of this long-term compounding.
You mentioned Peter Lynch, very successful investor at Fidelity, and his performance. What about Warren Buffett and Berkshire Hathaway? Can you speak to their performance?
Yeah, I mean, Buffett's absolutely amazing performance over the long term. When I got into the business in 1990, the stock was at $5,500. Today that same share is worth $735,000. I mean, it's astounding. It's absolutely astounding. So if you look at the Berkshire over the last, just look over the last 30 years, that would be from 1995. The stock was 21,000 back in 1995. Again, 735,000. So that's a 3,400% gain over that period of time. And, there were some ups and downs there. People in 1999, I went to the annual meeting for quite a few years and throughout the 90s and early 2000s. And in 1999, in particular, he was being almost yelled at by investors. You're crazy. You've missed the tech bubble, or they didn't call it tech bubble. Of course, he thought it was tech bubble, the tech upswing. And he was taking so much flack. His stock had gone from, I think, 70 or 80,000 down to 45,000 at the time. And he, was out of touch with reality, et cetera, et cetera. And then, of course, he had his best years right after that when the NASDAQ, dropped 80%. And so, again, you have to be prepared to buck the trend. And Buffett is, I think, one of the greatest investors of all time. His discipline. And I would always encourage retail investors, go back and read his annual reports. You can get just the annual reports. You don't have to look at the financials. And you get his letter to shareholders. And it is a wonderful read, and go back and you can read 30, 40, 50 years of these letters to shareholders. And you see the discipline, the focus, the consistency. Not perfect. He admits when he's made mistakes, errors of omission and commission. But over time, if you're right 70% of your time or more, you can make a lot of money. And if you learn from your mistakes and you're honest, then you can do very well.
All right, so you touched on this earlier, and that were some of the benefits of this long-term or value approach. And you mentioned one of them was taxes. So maybe you can just discuss that and what are the different tax consequences associated with value investing as opposed to short-term trading.
Yeah, and this is really important, particularly in fully taxable accounts. If you're in RIAs like in the US or RSPs, this of course is a little bit less relevant. But if you're in a taxable account, and this will explain why if you look at the Forbes 500 list and you say, who are these people? Virtually all of them on that list are long-term business owners, and they're focused also. They only have a couple holdings they've made their money on. And that's basically the predominant way that wealth is created. But if you look at the tax issue, so here's an example. Warren Buffett has used this example in the past, and I'll convert it to Canadian tax, but the point is similar when it comes to capital gains. If you start with $1 and you double it 20 times, so I'm talking about 100% each time, so 1, 2, 4, 8, 16, 32, and so forth. At the end of 20 doubles, you have $1,048,000. Okay, so what's the tax implication here? So in Canada, tax capital gains are approximately 25%. If you're in your highest tax brackets, let's just use 25%. The rates are not unlike that in the US, and you can apply whatever rate is applicable. So you pay your taxes, and at the end of that period of time, you'll have about $786,000 because you'll give up virtually 25% of your $1,048,000. Now, if you start with $1 and every time you double it, you do a turnover and you sell the security and you pay the taxes owing. And so you're not building up any tax deferral and allowing that deferral to compound. If you ask somebody after 20 doubles, what would your after-tax number be? Very few people would tell you that it's less than 10% of the $786,000. It would actually be about $72,000. Now, going from $1 to $72,000 is an astounding rate of return, obviously, but going from $1 to $786,000 is a much better return. And that's the power of deferring the tax, and then that deferral is working in terms of compounding more money for you. And that is why the wealthiest people in the world are business owners, because they defer the tax and they compound it for extended periods, providing they can grow it and reinvest, of course, back in their business. And that's exactly what Warren Buffett has done in his own stock. He's tried to keep taxes low and take the cash flow that are generated from his insurance businesses, his investment holdings, dividends, and so forth, pounds it back into his company, and he continues to compound the cash flow stream in the business. So taxes really matter. And so when you're doing short-term trading and giving up a lot of money to the government, in particular the U.S., if you're doing short-term trading there, the capital gains tax is actually higher. They penalize you for short-term trades. Then you have to factor that into your after-tax rates of return, because from a value investor's perspective, all that matters is your after-tax rate of return, not your pre-tax. And those can be quite different based upon your investment behavior.
Jonathan, you mentioned that the tax rate in the U.S. for speculative trading is higher than that for value investing. What about in Canada?
In Canada, our capital gains are taxed the same. Yeah, basically at this point, 1/2 of the gain is taxed at your marginal tax rate. So that's the way that works. So, but again, as I just caution people, always look at the tax implications of your investment decisions, and that will, I think, influence you to maybe look for longer term holds and your ability to compound without giving it up to the government every year.
Yes, the less we give to the government, the better.
We're much happier that way. I think it also helps in our mental sanity.
Another element I want you to touch on is risk management and volatility. And this is, once again, going back to this year. We've had a very volatile year, and risk management is very important when it comes to managing your wealth and growing your wealth over time. Can you just speak to that?
Yeah, and of course, people will use different approaches when it comes to risk management, and I'm definitely, I'll put my placard out there and say that, look, I'm biased because I'm more of a value investor. So for me, the protecting your risk is knowing what the business you're in and the risk of the underlying business itself. Not the way it's going to trade on the marketplace. And there's a big difference. So people can look at volatility on a stock, but is that really the underlying risk of the business? And in many cases, it's not. And so if you get into a market where there's a lot of volatility and you don't know what you own, then you can really get spooked in and out of these businesses and chase things. And new businesses come out, all of a sudden this is an AI stock. I'm just going to buy it regardless of the valuation because I think it's going higher. If you're a more disciplined investor, you'll sit back and you'll say, no, I want to control my risk. I want to make sure that if I'm going to buy this AI stock, that the fundamentals will support this price today, and the growth that I'm paying for in the future is not ridiculous and is actually tied to some reality. That can take place. So a lot of, I think, risk management really comes from understanding the business. Warren Buffett says the more you know and the less ignorant you are about your investing, the less you have to diversify because you can focus your attention. So I think a lot of, again, just managing risk is understanding the business and not getting sucked into just the volatility or the momentum or the headlines and chat groups and different meme stocks and things like that. That's a whole different way of investing. And I think if you're going to go down that road, realize that you're speculating and realize that the market can move against you even with all the best information in short periods of time. And time is not your friend, and you can end up losing a lot of money. And it's very hard to recoup that. If you're buying some meme stock or you're day trading and your stock drops 30-40%, it's very hard to get that money back. You've got to really, really struggle. And that's where I think one of the things about buying stocks with value and fundamental, balance sheet strength underneath them and cash flow is you avoid torpedoes. And you've been in the business a long time, Jimmy, and you know what I mean. That sometimes you get these torpedo stocks where you can just almost lose everything very quickly. And recouping that lost money takes time, and it's very difficult. And so I tell people, you want to avoid torpedoes. I'm fortunate really never to have a true torpedo in my portfolio, but then I'm very careful. I've had stocks that have underperformed and haven't done well, but haven't wiped out all my money in that particular stock. And I think that's much better risk management for people.
And we've seen that many times over the years. When you look at the tech bubble of the early 2000s, many of the stocks that were doing well in 98, 99 got completely obliterated in 2000, 2001. They got wiped out, never to return. We saw it again in the great financial crisis of 08, 09.
Yeah, and that's one of the things, survivor bias. So when you go back and look at numbers, I was looking at some of the hedge fund returns, So if you look at hedge fund returns just over periods of time, like over a 10-year period, only about 7% of hedge funds actually outperform the market index. And if you go 20 years, it's abysmal. It's just a couple percent. But what you don't factor in there is that you've lost a lot of hedge funds. They've disappeared. You're actually looking at the ones that survived. And so if you are again, taking a shorter term view where you have high feed, some of these hedge funds have 2 and 20, things like that. If you actually look at hedge funds that are more short term traders, and they have a high, 2%, minimum fee and then 20% performance. Very few of them are able to perform over time, and to add the kind of value that just long-term ownership in a stock or a handful of great stocks can do. So again, they have great sales guys and gals, and they've got great marketing, and it's slick, and they'll market year performance, 2-year performance, 3-year performance. But investing, I think, again, we're talking to investors, retail investors. It's all about repeatability and sustainability. The only return that really matters for most of us is your 20 and 30-year rate of return. Because that's what matters. You can have a great 3-year return, 2-year, 1 year, 6 months, and so forth. But then if you blow it out because you're not disciplined, in year 4 or 5, you're back to square one. So that's why, again, we talk to investors, have a sustainable, repeatable strategy that's rooted in fundamentals and protects you from, tremendous volatility in the marketplace or permanent losses in businesses that are, ridiculous in value. Because you mentioned the NASDAQ going up and the tech bubble of the 2000 situation. I mean, you had businesses that were trading just in the ether world. I mean, they were just crazy valuations, and they're gone. And then you've had tremendous businesses like Amazon, where we're also trading at high valuations, and then it took 10, 15, almost years or more to get back to the valuation. So you can still have great companies, and they can do very well in the long term. But you could underperform for 10 years, 15 years if you really overpay and sit on them. So again, these are things you've got to really get back to understanding what you're buying and what you're paying for the businesses.
So I want to take the other side of this argument now. We've talked a lot about the benefits of value investing, but I want to play devil's advocate now. And especially in the last 5 years, we've seen tremendous growth in the U.S. stock market, also the Canadian stock market, but not as much. And a lot of the growth in the U.S. has to do with this whole Mag 7, AI, et cetera. And that can be quite challenging for a value investor because you're watching these stocks that might go up 50 or 100% in a year. But meanwhile, your value stocks don't go up nearly as much. And I guess the second question I want to ask is, the world we live in now, like it's changed so much in the last 10, 15, 20 years, right? And it's like there's less and less fundamental analysis going on, more and more passive investing. This whole ETF world has really exploded. Can you just speak to that? One, how do you deal when you go through this high growth period like we've seen in the last few years? And two, what are your thoughts on whether or not fundamental analysis and value investing, is it still relevant?
Yeah, I mean, we haven't been shaken from our principles, and we've done very well and kept up quite well with the indexes. Although clearly the S&P 500 is one of the tougher ones. The TSX not as hard. The Dow has been easy. Of course, some of the smaller cap companies indexes, the Russell 2000, so forth. Those are much easier indexes to compare yourself against. But you're quite right. I mean, you can go through periods of time where you got the Mag 7, and these are amazing businesses too. I mean, these are powerful businesses. So when you look at the moats, the brand, the franchise, the ability to generate free cash flow and to compound that, it's all there. And so it's they've got great futures and so on. What do you pay for them? That's the question. What do you pay for them? So we look at them, we scour them, and we have owned, and we still have on our books. We have some Google on our books, and we also have owned Amazon through this period. We've been able to buy it. It got beaten up a little bit. 2022, 2023, it was down a substantial amount, almost 40%. And I think when we look at that business from a price to sales, price to cash flow, there's still metrics that are at least intelligible and can make sense. There. So we've been able to participate in, again, some of these fantastic businesses. Meta or Facebook, it just hammered a few years ago. And of course, it's up like 10 times from its low. But that was cheap there for a period of time also. So even with the Mag 7, there's been some opportunities to participate in some of those names. If you're a reasonably, value investor and you're having some flexibility there. So, but otherwise, yeah, you just look harder and look for businesses underneath the skirt that other people aren't looking at. Now, when you come to passive investing, yeah, this is really intriguing for us because you are getting sort of businesses being reinforced and less companies dominating the indexes, and then the money continues to pour into that. We view that as an opportunity for discipline. It means that we're trying to look for companies that are not influenced as much by the index. Therefore, they are cheaper. And our fundamental belief is that over time, people will pay reasonably, there'll be a correlation between, the price to cash flow across businesses that maybe are big in the index and companies that are not in the index, that people will ferret out these undervalued opportunities over time. And so we continue just to look for companies that aren't as influenced by the index. I think the index is skewing the valuations of some companies more. And I think that only means we're going to have a larger downstroke at some point and adjustment. I mean, we have to. You just can't run these things up completely to valuations that are totally ridiculous. So it doesn't change us. We continue to look for companies below the surface, and we can be quite successful there. And sectors that are out of favor. As you know, we've been in some of the precious metals sectors and things like that. For the last couple of years, no one wanted to be there. I mean, Canadians have almost no money in that sector. The Americans, the same thing. Europeans, maybe a bit more. And so we look for sectors where even if you have index, for precious metals companies, no one wants to buy those either. And so you can find valuations, good valuations in that space. So we stay disciplined. We're not going to throw out our fundamentals just because there's some shorter term trends that might be obscuring those or making them more difficult to be successful.
Yes, the precious metals have really come alive here in the last few months. Jonathan, as we wrap up, why don't we spend a few minutes just summarizing the benefits of value investing?
Yeah, I think the benefits of taking a more disciplined approach and keeping the turnover, lowering the turnover, so you're not flipping through stocks as rapidly as I think it fits with historical returns. I think over time, the sustainability and repeatability of higher returns are those individuals who are disciplined, who take a longer term disciplined approach to investing. Again, you look at the day trading numbers, there's studies that have been done. I went through like 5 different studies looking at shorter term investing. And only over time, if you get a 10, 15-year period, there's about 1% to 2% actually outperform and create excess rates of returns. It's very difficult, especially just retail investments. So that would be one, is historical returns that are better, I think, if you're more disciplined. Second, risk control. I think you can, again, protect your capital better if you know the companies you're investing in, and you're investing in really, really strong companies with strong balance sheets that can weather, the challenges of the broader economy from time to time that inevitably will hit the marketplace. Third, I think it's better from a human behavioral perspective. If you are a longer term investor, you're not freaking out with the market all the time. You're not, you're watching the market every single moment, wondering whether you should pull your money tomorrow or, this afternoon type of thing. And so I think, again, you can be much more stable in your approach and enjoy the market and enjoy investing and take a longer term view. And then the tax efficiency, you drive up your tax efficiency if you're not trading all of the time. So I just, it's really my psyche. I'm definitely biased, and I understand that some people like the short-term buzz, but you got to be careful that you're actually not a gambler and speculator. And if you are, the numbers show that it's very hard to repeat and it's very hard to outperform over time. Be honest with yourself. It does not work for the vast preponderance of people. And the very few people you hear are successful in short-term trades, are they successful over 5, 10, 15, 20, 30 years? Because really your time horizon and your overall returns, you've got to look at that over a long period of time. Don't cheat and just pretend, you made a lot of money this year and trading stocks. Great. You've got to repeat it. Otherwise you're going to end up losing it at some point.
Jonathan, when I hear you talk about value investing versus more short-term speculative investing or trading, it kind of reminds me of investing in your home. When you buy your home, you're not thinking about selling it in a year or 2 years down the road. You want to hold on to it for 10, 20, 30 years. And that's when the value of your home really goes up, is over the long period of time.
Yeah, I mean, Warren Buffett has this. We again go down to the annual meeting. He uses this example. He says, if someone came to the front of your door every day at your house and offered you money for your house, and one day it was $800,000, and the next day someone goes, I'm only going to give you $675,000. And you go, oh my goodness, my house has just dropped $125,000 or something. And then the next day it's up to 900. You go, oh, I feel better. You got to be careful because it's an auction. The market is an auction. And, Ben Graham has that famous expression that he has said, that saying that he has is that in the short run, it's a voting machine, very emotional. In the long run, it's a weighing machine. It weighs values. So, yeah, one of the downfalls of the stock market is it's flashing numbers at you constantly. Doesn't mean they're right. What's your time horizon? And if you're getting all your cues just from the volatility in the market, it's almost impossible not to make all sorts of mistakes. So that is one of the benefits of the private market, because you're not getting the valuation flashed in your face all the time. And I've been on endowment boards, and with pension funds and things like that, a lot of them try to put more money into private investments because they say, well, it doesn't you don't get the price volatility. Now there's a whole different argument there, but what they're trying to do is get away from this day-to-day just pricing assets constantly and holding people accountable to just stock market moves and not really what's happening in the underlying business, right? And so I think, there's some good points that people should bear in mind when they're investing.
Well, Jonathan, that was a great discussion and very insightful. I want to thank you. And if someone would like to get in touch with you or learn more about your firm, RockLinc Investment Partners, where can they go? Yeah,
best place is the website, rocklink.com. Link is spelled with a C at the end and not a K, so rocklink.com. And you can just send us a note at info@rocklink.com. And love to hear from the listeners and the viewers. And if you want a free look at your portfolio, we're more than glad to do that. So by all means, reach out and talk to us.
Jonathan, once again, thank you.
Thank you very much, Jimmy. All the best.
Don't forget to sign up for our free portfolio review with one of our partners at wealthion.com/free. With markets at all-time highs after a crazy year, now's a great time to review your portfolio and get prepared for what's to come. Thanks for watching, and we'll see you back here soon.